All right, we're going to let people trickle in, but we're going to get started right now with our January Lunch and Learn on property tax appeals and tax issues for 2021. Welcome to today's Lunch and Learn, sponsored by Landmark Credit Union, who is our presenting sponsor for the Lunch and Learn series. Today's program is going to go from noon to 1 p.m. We invite you to ask questions throughout the session, but we'll leave the last 15 minutes exclusively for that Q&A. Our Lunch and Learns are designed to highlight member companies and their expertise. We draw upon content from a variety of different industries. So if you have an idea or content to share, please let us know. Again, today's program, January 20th, 2021. All attendees are muted and your video is disabled, just in case there were any questions about that. We always have to do a little bit of Zoom housekeeping. If you'd like to ask a question or chat, please do so on the keys down below on the screen. Again, today's Lunch and Learn sponsor is Landmark Credit Union. We're so grateful for all of their support. We're also grateful for the support of all of our annual sponsors. Our partner sponsor for 2021 is Ergens. Our diamond partner is Innovative Construction Solutions, and as I mentioned, Lunch and Learn sponsor Landmark Credit Union. Our presenters today, which we'll have do self-introductions in just a couple minutes: Danielle Lewis, Senior Manager and CPA at Wipfli; Joshua Graham, Partner and CPA at Wipfli; and Chad Zeznanski, Director and CGA, also at Wipfli. All right, we're going to stop share here and start with our introductions. So Danielle, why don't you tell us a little bit about yourself, what you do, and then our first question to dive right in. What are some of your thoughts on the upcoming tax legislation?
Yeah, and thank you, Tracy, for letting us kind of join you and everyone else for this Lunch and Learn today. Super excited to be here. So I'm Danielle Lewis. I'm a Senior Tax Manager at Wipfli. I hub out of our Minneapolis office, but kind of work nationally with our construction and real estate team. I lead our Opportunity Zone group as well as our Thought Leadership group. So I'm always looking for, new exciting tax kind of planning opportunities for those I work with. And as far as, upcoming legislation and what to expect from the Biden administration, obviously he was kind of sworn in just shortly, an hour and a half-ish ago. I wasn't actually able to watch the inauguration, but what to expect going forward. I think a lot of us after the election were waiting to see how, the Georgia runoff elections went, to, see the inevitable Senate placement. And so because of that, there is an expectation that, things will probably actually get passed through the Senate and House in the upcoming year. So really it's a focus on, what the administration is going to really put themselves in charge of the soonest. Right now, Biden's plan was essentially to increase tax rates. So individuals would go back up to 39.6%, corporations 28%. He's really looking at repealing like-kind exchanges for certain income levels. I think those of us in like the 1031 group would be pretty adamant in saying that, there's been a lot of lobbying done to really teach people what 1031 exchanges are and what they do, and how they actually stimulate the economy way more than that they are a, tax saving opportunity. So I think a lot of us are still very optimistic that there won't be any changes there, which would be probably one of the greatest things to affect, people in real estate. But other than that, I think we're probably looking at increased tax rates, and possibly we'll have to see if he ends up overturning some of the benefits that were part of the CARES Act. But for now, we're kind of in limbo waiting to see what's going to happen.
Great, thank you. Joshua, why don't you give us a little self-introduction and then maybe your take on what some of the upcoming legislation might look like.
Absolutely. Thank you, Tracy. Yeah, Josh Graham. I am a partner here at Wipfli, based out of Chicago. I lead our construction and real estate tax practice in Chicago. I work very closely with Danielle on a lot of different tax topics overall. We're both part of a lot of different national teams that we have. I work with Danielle on the opportunity zones, on our thought leadership. And we're both part of our national tax office for the real estate team in general. So we're constantly trying to think of ways to save our clients money with the tax law changes, with all the stimulus packages and otherwise. A lot of good things that come out of them. So at a high level, that's kind of what I do. Danielle did a really good job of summarizing kind of what's been in Biden's plan that we've seen so far, so I won't rehash any of that specifically. I will say that, I mean, we obviously are still going through a pandemic and trying to get through COVID-19. Even I believe, I mean, COVID-19 is going to be the new administration's #1 priority. So I don't necessarily, even though there could be and likely will be tax rate increases at some point, I think they'll be somewhat smart about it and not just do it right off the bat and kind of make people panic. I think it'll happen hopefully at the right time once things are under control. And I'm also not sold that they'll repeal like-kind exchanges once they kind of really truly understand the impact that it has to our economy in general. One positive that I've seen from an individual perspective, there's a $10,000 state and local tax deduction limitation. This actually might impact Chad's business. And so that there's a $10,000 cap, and I think that there's a good chance that gets repealed. And so SALT deduction, state and local tax deductions, hopefully from an individual standpoint, there won't be a cap. I could definitely see that happening, which would help for me living in Cook County with those high property taxes, being able to deduct them. So I do see that coming.
Great. Thank you. Chad, let's move over to you. A little self-introduction, and then any thoughts that you might have about upcoming legislation. And then I know that you have a presentation that you'd like to share as well. So we'll get into that after your introduction.
Sure. Well, my name is Chad Zeznanski, as previously mentioned. I am the practice leader of property tax and consulting and appraisal services at Wipfli. My background, obviously, I started with American Appraisal out of school. I did commercial appraisal work, did that on a national level, really kind of learned how to do valuation on all types of properties, from casinos to nuclear power plants. And then I've got into, years later, some development, some commercial brokerage, and some development. And then came over to Wipfli here almost 8 years ago, started the practice of the property tax services. And so that's where I'm at now. With regards to the new legislation, for property tax, I'm not seeing something taking effect for 2021. I don't think we're going to see any immediate increases or relief for this year. I mean, it's going to be something that we'll see maybe in future years. So at this point, I'm not seeing anything that we can really count on. So.
Got it. No, and I think that's a good point. Some of these timelines, and Josh, you had mentioned, the fact that we are in the middle of a pandemic, and there's all kinds of these external factors and all these other policies that are interplaying at this point. So, with that, Chad, if you'd be so kind, I know you have a presentation prepared, property tax appeals and issues. So property tax and property tax is the biggest issue for our industry. And I know that with your background in appraisal and your expertise, you have some conclusions and some information that you would like to share. So if you could just take us through this presentation, and then we have a couple follow-up questions.
Yeah, I mean, it's a brief presentation. It's basically an overview of the property tax appeal process. And so let me start out with just again, it's just a general overview. So we have the first slide here. So I think everyone knows that property taxes are based on the assessed value of your property as of January 1st of the tax year. What every property taxpayer should know is that the assessed value is based on the local assessor's estimate or opinion of the property's fair market value. And the key word here being opinion. It's their opinion. Now, property taxpayers have the right and the ability to contest the assessor's opinion of value every year. So every year, property taxpayers should review their assessor's opinion of value. And with COVID on the scene for 2020 and 2021, every taxpayer should pay particular attention to their notices that will be coming out in March. So assuming a 3% average tax rate for commercial property, that equates to about, or does, $30,000 of property taxes per $1 million of value placed on that property by the assessor. Another way to look at it is for every $1 million of reduction in assessed value, you'll save $30 in property taxes annually moving forward. Now, typically there are three ways for a taxpayer to reduce their property taxes. And now the first one is get a reduction in the assessed value that the assessor places on it, a change in use of the property, usually a lower or higher and best use, and the third way would be racial study evidence or uniformity, where the assessor is not compliant to uniformity. But in most cases, you'd only consider contesting assessor's opinion of value, assessor's opinion based on fair market value. Now, we don't have time to go into the whole technical detail of each step in the process, so I'll do a walkthrough for what I expect for a typical appeal of a new client in 2021. So due to COVID, obviously the client who owns a commercial property, the revenue has probably been reduced. Expenses have gone up, and they're going to be expecting a reduction in their property taxes based on the revenue. So sometime in March, they're going to receive the new assessment notices, and either that assessment is going to have stayed the same, increased, or go down. In most cases, and I would be predicting that it's either going to stay the same or even go up a little bit. And that is when clients will call me. They're going to be looking for some relief. So let me run through the process for a typical appeal. If you're doing this yourself, or if I'm doing this for a client, my first step is going to the client, and I would ask for income and expense information for the last 3 years, along with other data, possibly blueprints, maintenance and expenses, and I have a whole laundry list of stuff we'd ask. At that point, I would do my own analysis, maybe a mini appraisal evaluation. I really shouldn't call it an appraisal, but evaluation. And I'm going to determine what the fair market value of that property is and what I think the assessment should be. And if it's high, obviously, and it's more than what, if it's lower than what the assessment is, then we need to contact the assessor, and we're going to move forward with the process. Obviously, if my value comes lower than the assessment, we don't want to send up any red flags, and we just leave it alone. But let's assume that my value is significantly lower than what the assessment is. The first step in the process after you receive your notice is what they call informal process, or the open book period. And any taxpayer can do this, and you'll see that on your notice. And it'll state when the time is and when you can reach out. And you reach out to the assessor, and basically you discuss with him how they came to the value and why you think your value is lower. In your opinion, it's lower. In my case, I'll have some support put together. But again, any taxpayer property taxpayer can go in and talk to the assessor about it. But it is a period. They'll only talk to you. They'll put it on your notice, and you have a few weeks in which you can actually contact them. This open book period. Now, in my experience, it's been where the assessor, they'll talk to you. They're very cordial. In most cases, I don't get much traction. I don't get a settlement. I don't get a reduction at that point. The assessors are just kind of going through the process. Not all, but many of them. The next process is what they call a formal, it's called a formal administration process. Let me go to the next slide here, though. In the formal administration phase or the board of review phase, that is where you complete a form. You fill out a form. It's a 2-page form, and you present it to the city clerk, and you're requesting a hearing in front of the board. And the board is board of review, and that's made up of anywhere from 4 to 8 members of the community, and it can be anywhere from a homemaker to commercial real estate appraiser to a real estate attorney. There's no set criteria to be on that board. Once you fill out the form, you also have to submit your evidence for the hearing. Now, at this point, the assessor knows you're serious because there's going to be a hearing date set, and you can contact the assessor, and you're more likely to get some traction ongoing because now the assessor has to be prepared to go to a hearing and an actual. I put it, it's more of a mini trial. You actually go in there, you present your evidence. As a taxpayer, you would present your case. The assessor would present his case. You would question the assessor. The assessor would question you on how you came to your evaluation. It's just like a small mini trial. At the end, the board, they act as the judge, and they decide who they think is correct. Unfortunately, Wisconsin state statutes for board of review purposes state that the assessor opinion of value is assumed correct, and the burden of proof is on the taxpayer. So from my experience going to that actual board, it's more of a formality you're going through than you're actually going to win that case. It's very hard. I've won the case a few times, but it's not a normal. The reason for the board, the reason why you have to go to the board is if you want to get to the next level, which would be the circuit court. And the statute states, and it's very clear, that in order to bring your case to circuit court, to go to the next level, you have to go to the board of review, you have to present your case, and you have to get a determination. If you don't, you lose all your rights for that year to take your case to circuit court, to sue the municipality. So in many cases, I think I see a lot of my clients think, well, I'll just go to court, we'll just sue them after, down the road. And they find out that they have not gone to that board of review, have not done that process, and they can't do anything until the following year. So that's a real important process in the step. Let's go to the next slide. I think we go through all the formal petitions here. I think, so after you go to the board of review, and for my clients, after I would go to the board of review, and if we determine that this is a large enough case, and I do not get a settlement prior to the board of review, and there's a large enough assessment, and we decide we're going to take this to circuit court, obviously I go to the board of review. 95% of the time we get a determination where the board goes along with the assessor's value, and then we file a complaint to circuit court, and we fight our case in court, where at that level the assessor is not assumed correct. It's an even playing field. And I have many cases in circuit court right now. And usually in that case, 90% get resolved on the courtroom steps. They do get resolved, they do settle. So somewhere in this process, I know it sounds like a long process, somewhere in this process, be it open book, be it before board of review, be it between board of review and filing a complaint, or the day of the actual hearing for circuit court, a settlement usually happens. So in wrapping up, I guess I'll mention a few things. Is if you would be doing this yourself, or if you're having a rep do it for you, one thing to remember, in short, working like with any government body, carefully monitor every filing date, properly completing the paperwork, submitting all the documents required. I have been, my hearing for the board of review, like I mentioned, how it's so important to go to the board, I have been rejected to be heard because on the form I have put NA instead of writing out not applicable. And they rejected the board rejected my request, and I was not able to go to the board of review. Now in that case, we wouldn't have gone to circuit court anyhow, but it was rejected. So my point is, if you're filling out these forms and you're going through the process, you have to, cross your T's and dot your I's. Next thing I want to mention is never assume anyone at the assessor's office is your comrade. They're there to walk you through the process, but if you're looking for help and you're looking for some insight and some really good direction, that's not what they're there for. And so be careful with that. If you do get a settlement, you work something out with the assessor anywhere within this process, make sure you get it in writing. Make sure they give you a waiver form, you get an email, you need something in writing. I've had many times where I've had an agreement and then the assessor would come back and say, that's not what we said, that's not the number, and then you're starting all over again. And then I think the last point I want to make, one of the last points is the size of reduction you're seeking will determine your path due to the cost associated with the appeal. I mean, if you're appealing property that's $1 million and it's $200,000 over assessed, it just wouldn't make sense to take that to circuit court. You'd never recoup that money. And again, as I said, almost all of the property tax cases will settle somewhere within the process. So that is where I will leave it on my end for this. I guess we'll answer questions at the end, or I'm not sure how you want to handle it, but try to make that as brief as possible, summing up a lot in a short time period.
Yeah, so thank you, Chad. I actually have a couple follow-up questions.
Sure.
And as I mentioned before, we're going to cover a lot of different areas here. I know this was your specific area of expertise, and it is one that we get pulled into a lot, or our members get pulled into a lot just in everyday dealings. So you had made reference to this before early on in your presentation about that most commercial properties, as you're seeing it, the revenue has gone down. How is that? Can you speak specifically to different sectors? Because from what I'm hearing, manufacturing is doing well. Most of the office owners are still continuing to collect a rent. Can you speak to that a little bit more and how you see that changing going forward?
Yeah, I mean, I think what we've seen is, like I said, different sectors, and I think obviously you're looking at the hospitality sector, hotels, restaurants, anything with tourism. All those type of commercials have really been hit hard, and obviously the revenue's been hit hard on that. certain types of offices have seen a drop off. Tier 1 type of office facilities, urban, suburban office buildings, they have seen a drop off. Obviously, many of the tenants aren't renewing their leases, or they're leaving because working from home. I think we're also going to see a lot where, I'll just take for example with Wipfli, we were looking at moving into the 3rd floor of the building we're at. I think now you're seeing a lot where this work at home business is working well for people, and they're going to be like with Wipfli. We're not taking that space anymore. We're going to transition to, once this pandemic's over, we're going to transition from some people working at home, some working in the office. We won't need as much space. So I see in office that there'll be a reduction in revenue there also. I think another example you don't think of is nursing homes. I've seen people say, well, why would nursing homes or assisted living go down? Well, you're not going to put your mom in a nursing home right now. You got everybody coming out, but nobody going in. So they're hurting. They're hurting on the revenue side. So I think you see that. Again, those are some of the sectors. I think manufacturing, yeah, I don't think you've seen a big hit in manufacturing as much. So you haven't seen it in warehousing. Residential, obviously single family residential, not so much. But large apartment complex, I have some stuff, a few things on the East Coast. They've seen massive hits with people moving out. They couldn't afford to stay and rent, and moving back home with their parents, or moving in with friends, and or just not paying the rent. So I guess hopefully that answers your question.
Yeah. And now I have a follow-up question. Actually, it's a similar question on dark stores. This is a terminology that we hear a lot, especially when it comes to these lawsuits. And I know there are lots of advocacy campaigns, especially in the last few years, related to dark stores. Can you talk about your opinion on that, and maybe about the loopholes and how that's being discussed and positioned?
Yeah. Well, I think I'll start off with wearing my property tax consultant hat. And I have strong feelings on that whole dark store theory and the loophole. I mean, I find the application of the dark store theory and the loophole argument actually insulting and attacking for tax reps. I mean, I think everyone will agree. Just the name dark store and loophole sounds kind of sinister. So it's painting us in this light right away. We're trying to pull a fast one. I mean, and as soon as I mention any property, I go into an assessor's office, and I'm mentioning, we think we're overassessed. The first thing that will come out of an assessor's mouth, not all, because I'm not putting them all, but many, will be that dark store. They use the dark store or the dark store, and I'll say, well, can you explain what your dark store is? What is that? What's going on there? And usually I really get a vague answer. So again, for me as a tax rep, I just think it implies a deceitful methods and a way of trying to obtain lower assessments. So I think a way to explain the dark store theory is you have to distinguish, and get comfortable, you have to distinguish between market value and in-use value. And it's really what we're talking about here. And market value represents the price a buyer would pay for property under prevailing market conditions. The in-use value is what an existing owner would pay as an ongoing operation. A lot of times we call it in-use assumed earnings. And wearing my appraiser hat, it's two different premises, and you would come up with two different values. And as an appraiser, you can value something based on its fair market value or its in-use value, and they will give you two different numbers. But the statutes right now within the state says for property valuation purposes, for tax purposes, you value it on fair market value. This dark store theory and everything behind it is the assessors want to value commercial properties or retail properties based on its in-use value, which is a much higher number. And if they go and they change the law and they tell us that's the way it should be valued, then that's the way we value. But that's not what the law says right now. It says fair market value. I mean, I guess I give you an example. For example, let's say you have your home and you really love racquetball, and you decide in your living room you're going to make a racquetball court. And you spend $50,000 to put the racquetball court in there. That's value and use to you, and that's what you want to do. Now, down the road, you decide you're going to sell your home. You got the racquetball court in there, and you find out potential buyers don't want a racquetball court in their living room. They want a living room. And not only will they not pay you $50,000 more for that racquetball court in your living room, they're going to pay less because they're going to have to turn it back into what it was. So the value and use is what that racquetball court was worth to the owner of that property. The market value is getting that back to where it's at. And that's typical with a lot of big box retail commercial properties. The value and use to them, they build a property for them, and that value that cost is higher to them. But when they turn around and sell it, it's not that cost. And that's where the rub is. That's where assessors want to value that at the cost of the value and use, but the statutes say fair market value. But I don't know where the loophole is in that. It's not a loophole. It's not a dark store. The dark store comes in from they're saying to use properties and in use a property that's been leased out compared to a property that's vacant. The dark is really, again, it makes it seem like something scary is going on there, but it really what they're talking about is a vacant store. And I think a lot of the commercial brokers will tell you they sell properties all the time that are vacant, and they sell for market, they sell for a good price. Just because a property is vacant doesn't mean it's distressed. And that is kind of what this theory is trying to portray. Okay, so then that's a long answer to your question, but it's something that really hits me strong.
Yeah, and it definitely hits a lot of our members strong, because I think, just as you expressed, there's lots of interpretations for what does this mean, not only in the short term, but by definition, how does it fit state law, what's written, in statute. So, I think there's still a lot to be learned by lots of people who are kind of throwing this term around. So if you were looking at the landscape today, understanding, that there could be changes in the assessed value or in different categories, I mean, do you see there being a conflict here with the way that properties are assessed moving forward? And are we going to be hearing more about dark store or property tax, folks who are trying to negotiate lower property taxes?
Well, and I have some here in Wisconsin. There currently there's a recent push for legislation that would effectively overturn the Wisconsin Supreme Court ruling back in 2008. It was Walgreens versus the city of Madison. Everyone's probably heard of that. That was in 2008. In the Walgreens case, the court held that fair market value of property subject to a lease agreement must be based on market rents rather than the contract rents. And again, that's kind of going back to that where that dark store would come in. Being, if the contract rent, you probably have somebody in that facility and they're leasing it out. Market rent is it's vacant and available, and what the market would pay for someone to come in there at that particular time to lease it out. So anyhow, so the court reasoned that contract rents often reflect artificial increased sales prices caused by unusual financing. So courts have ruled in all cases that this whole dark store, that the way things are right now, that you should place the value for property tax purpose and assessment based on the fair market value. They have ruled, and they have consistently ruled, that that's the way it should be. But there is legislation now pushing the dark store, pushing this loophole thing that's going on, trying to get that overturned. That hasn't been, and I'm hopeful that it doesn't as a property tax rep, but not sure where it could go.
Okay, well, we'll be following that closely. I want to switch gears a little bit now. I mean, we have a lot of ground to cover. I mean, especially with so many things happening with legislation currently tied to COVID relief. Danielle, Joshua, can you talk about some of the recent changes that were made to the PPP program and any commentary on the new funding that might be available?
Yeah, absolutely. And I prepared a slide to make it easier for people to follow what's actually happening. Let me share it real quick. All right, and hopefully, can you guys see it still? All right, getting a nod from Tracy, so that's good. Okay, so with the new stimulus package that came out, also known as the Consolidated Appropriations Act, it gave us new funding for PPP, and it gave us some changes to PPP Round 1 and just overall with the program. So I'll try to hit the highlights real quick. So I think there are two huge changes to PPP Round 1, which then will continue if you end up applying for a second loan. One is that the deductibility of those PPP funds, the expenses that you use them for, are now tax deductible. I don't know if everyone on the call realized this or didn't realize this, but up until recently, if you got your loan relieved and you didn't have to pick it up as income, you actually weren't eligible to take those expenses as deductions. And there's a lot of pushback on that because people thought, well, then you're kind of picking it up as income because you're not getting the deduction for it. So the government finally made the rule change. And so any loan forgiveness, either with PPP Round 1 or in PPP Round 2, is now deductible. So that's huge for everyone that's getting loan forgiveness. And the second biggest thing is that they came out with a simplified forgiveness application, and actually they're in the process of coming out with it. So if your loan is for $150,000 or less, and you have not already applied for forgiveness, I would recommend holding off, because they're essentially releasing like a one-pager where you have to fill out relatively minimal information compared to the original loan forgiveness application. I mean, you still have to meet the requirements and pay and use the money for the appropriate things, but there's a lot less that you actually have to submit to the bank. And so if you haven't already submitted for forgiveness and your loan amount is for $150,000 or less, that application should be coming out anytime now. And so we would recommend waiting and just submitting that, because it's going to make your life a lot easier. And I will say the third biggest change that also applies to both rounds, if you haven't applied for forgiveness yet, is that there was an expansion of the costs that can be covered with your PPP loan proceeds. You still have at least 60% of the proceeds need to be paid for payroll, and you could still use 100% of it on payroll. But in addition to like utilities and rent that you could use it on, they added, I believe it's like 4 different topics. The 2 biggest ones that stood out to me were kind of software/cloud computing costs. You can utilize your loan to pay for that, and any PPE equipment that the company is purchasing, you can utilize your loan proceeds for that stuff as well. And so that's big, just in terms of being able to meet the costs that you need to spend to get full forgiveness if you weren't able to meet them previously. And then just FYI, there is a second round of PPP funding that I think there in the new act, there's about $284 billion that were kind of put for this program for small businesses. I believe you have until March 31st to apply. Some banks have already opened up their application process. The new application is out. And so a couple caveats on this one. It's for 300 employees or fewer, for companies with 300 employees or fewer. And the biggest key, I think, compared to the first round is that you need to have a gross receipts reduction of at least 25% in any quarter of 2020 compared to that same quarter in 2019. You also need to get your first loan. You need to have utilized all of your proceeds from the first loan. But anyways, so you can qualify for 2 sets of funding if you meet that kind of gross receipts threshold and you meet the employee threshold. There's a $2 million limit now. They upped the potential benefit to certain businesses, 2.5 times your average payroll for most businesses, but it's 3.5 times payroll for like the hospitality industry in general, that you're going to see restaurants and some other businesses that meet the right qualifications, so they can get some extra money. And I think one other thing to add, just big picture, if you did not apply for PPP Round 1 and you are interested in still applying, then you don't need to meet the 25% reduction in gross receipts test. That test is only if you're applying for if you're going for the second round and you already got the first round and you're getting it forgiven. So if you didn't get money the first round, you don't have to hit that gross receipts reduction threshold to get to qualify.
Do you anticipate that round 2 will also be forgiven? Is that kind of baked into this?
Yes, yeah. So I think, yeah, the rules that I covered for the changes to PPP round one will apply to round 2. So those, assuming that you're forgiven, you meet the qualifications, which is essentially spending the money on the appropriate expenses in a certain time frame. But yeah, it's one, you should qualify for forgiveness, and 2, those expenses will be deductible. And there will also still be, to our knowledge, the simplified forgiveness for loans that fall under the $150,000 threshold. So it'll be quicker and easier for those.
How familiar are you, or have you worked with clients that are taking these loans as independent contractors?
Decent amount. Yeah, that's something that we've helped several of our clients with, either independent contractors or I work a lot in the partnership world for taxes. They own real estate and they don't have payroll per se. And I think the key is income that's subject to self-employment. So if you are independent contractor, you end up filing like a Schedule C. If you are like in an income position, then you could qualify based off of your income. If you are in a net loss position, I don't think you're generally going to qualify. So it's kind of based off of income that's, to my knowledge, it's income that's subject to self-employment. Is the easiest way I can explain to look at it at a high level.
No, I think that's great. I know as you know, as an organization with many independent contractors, and of course many of our members tied into real estate holdings, I know that there were a lot of questions and some hesitancy, and also perhaps a little bit of confusion when it came to the EIDL loan as well, because they could only take one or the other. Can you speak to that in terms of any clarification? If you have a recommendation, do they qualify now for PPP Round 2, even if they did get an EIDL loan? What do you know about that?
Man, keeping me on my toes with all this stuff. And just want to make sure, I'm going to do like I want to make sure I talk about the right thing and not the wrong thing.
Oh, these were not prepared questions. Sorry about that.
No.
I can come back to it too.
So there's an EIDL, there's like an advance, and then there's like an actual loan. So back in the early 2020, when this first started coming out, like there are a lot of people that applied for EIDL and they got like the grant, which is I think up to $10,000. And you didn't really have to fill out a whole lot for it. And so if you did get that like up to $10,000 and then you also went and got the PPP loan, what essentially was supposed to happen was, I'm just going to make it up, but let's say I applied for $100,000 of PPP loan and then I got the full $10,000 of the EIDL. The EIDL was supposed to reduce the amount of, I think, forgiveness that I could apply for. So if I got $110,000 total, 100,000 from one program, 10,000 from the other, the 10,000 I got from the EIDL, I would not have to repay. The 90,000, and I think the way it would work is it would reduce your $100,000 of PPP that could be forgiven to 90,000. So you would be maxed out at 90,000 forgiven. So I haven't seen anything that says you can go and get both sets of dollars and have zero consequences, I guess.
No, that makes sense. So I want to move to the CARES Act and just maybe go back through some of the greatest benefits to real estate professionals as you guys see it, or as you see people taking advantage of it. Are people running into roadblocks as they're trying to figure this all out, specifically to CARES? So I don't know if that Danielle or Josh.
Yep, that's me. Thank you, Tracy. Yeah, so the CARES Act was passed early in 2020 as to provide relief for people during COVID, as well as kind of pushing through some different tax changes that we had actually been waiting for quite a while. So there are two kind of things I want to highlight. In the interest of time, I still want to make sure we're leaving a little time for questions if possible. But two sort of things, and that's the first one's qualified improvement property. So this is going to be property that is on a commercial building, that's like your tenant improvements and everything like that. In prior legislation, they essentially accidentally wrote it into the regulations that it was going to be 39-year property, thus making it completely ineligible for bonus depreciation. And us as tax professionals have been like waiting for them to kind of make this correction, and they finally did, moving it to 15-year and now eligible for bonus depreciation. And the significance of this is pretty grand because it really qualifies pretty much since TCJA was enacted. And what it really requires is a very detailed look at the past couple of years, figuring out how things were capitalized, whether or not you have to change those items, and even bigger, whether or not, a cost segregation study makes sense now based on, kind of where you're at. So that's one big thing. And what it kind of rolls into is also the net operating loss change. So as part of the Tax Cut and Jobs Act, they created both kind of a couple changes to NOLs. One of them was that they made an excess business loss limitation. So without getting into the details of the numbers or anything, essentially your losses could be limited based on, where you sat income-wise, which was a huge change for a lot of people. They were no longer able to offset all of their income with net operating losses as they always could in the past. The CARES Act repealed that and also now allowed us to carry NOLs back 5 years. Under TCJA, we were only allowed to carry them forward. So those are two big changes. Not only now can our clients and taxpayers, utilize these losses fully in the year that they incur them, they can now also carry them back 5 years. And where we see the tie-in a lot with that is in the real estate industry is going to be that qualified improvement property and doing cost segregation studies. So as a quick cost segregation study explanation, that's essentially when you've got a building, we have engineers go out and look at them, and they break out, instead of having to depreciate maybe a commercial building for 39-year, they go in, they look at the different components that comprise of the building, and they're able to break them out into shorter useful lives. So now instead of having, $1 million being building being depreciated is 39 years, we're now able to maybe carve out 25% of that and now make it eligible for bonus depreciation and really accelerate the deductions. So it can be a massive benefit to kind of pair a cost segregation up with this new legislation change because it is set to sunset. So it's super important to kind of look at different opportunities that you may have with properties that you may hold to see if whether or not a cost segregation study makes sense, as well as then tying in the qualified improvements and looking back at your past depreciation schedules and seeing if any of those should really be changed so that they're eligible for that 15-year and bonus depreciation, and that's done on a different form, Form 3115, but it allows you to essentially catch up on that depreciation you should have taken or could have taken, I guess, in this scenario in prior years, but we're not able to because the law had changed. So those are two really, really big things with the CARES Act, is really taking a look at your real property, seeing if it's eligible for a cost segregation study if you haven't done one before. And then looking at maybe your past depreciation methods to make sure they align now with the new tax law. There's a lot more to it too. In the interest of time, I won't really get into it, but there pretty much because of the CARES Act and then also the newest Consolidated Appropriations Act, there's a lot of reasons to look back at things and choices maybe you and your CPA had made in the past and kind of reassess to make sure that they still make sense. Especially with NOLs, it requires a lot of analysis. And CARES Act also, not every state is conforming to different components. So it's a very big conversation to have. And I think our point of bringing it up again, I know this is kind of more old news, but just because there were so many changes and people maybe filed their tax returns even before the act even, kind of was enacted, it's just a really big reminder for people in the upcoming, opportunity tax season to kind of look at those different items.
So you had mentioned a sunset in there. What was the sunset, and do you know the timing of it? That's the first question. And then secondly, real specifically for 2020, can you just re-emphasize those points that people can take advantage of right now and should be looking at right now?
Yep. So I'll start with that piece. So for things to look at for your 2020 tax return, it's not too late to do a cost segregation study. That doesn't have to be done in 2020 to be used on your 2020 tax return. So you're definitely still able to do that. So I would, look at your project, see if a cost segregation study is good, and then look to see if any of the properties that you do have that were commercial or non-residential, that they're, that you didn't take qualified improvement property as 39 years in the past, and that is now eligible for that 15-year bonus. And if so, maybe you can do a 3115 to kind of adjust that. As far as the NOL carryback, so under the CARES Act, NOLs generated after 12/31/2017 and beginning before 1/1/2021, those ones are still eligible for 5 years carryback and an indefinite carry forward. And then we also don't have that excess business loss limitation. So pretty much anything for 2021 and beyond is going to have no carryback, and your business losses are going to be limited to 80% of your taxable income.
Okay, well that's great. Lots to remember. Wow, because we have nothing else to think about right now. A question about a very specific point, and you had kind of teed me up for this, about the Consolidated Appropriations Act. Can you speak to that and the impact on our industry?
Yeah, and I will take that one. And I know we're low on time, but I'm still going to share my screen, and I don't have a 1 o'clock cutoff, so I can stay on if people still have questions. Tracy, you might not like that, I don't know. But okay, so a couple things I wanted to point out real quick. Hopefully you can see my screen now. The employee retention credit. So this wasn't new. This came out with the CARES Act, but they changed the rules with the Consolidated Appropriations Act. Because with the CARES Act, originally, you couldn't qualify for both the PPP and the employee retention credit. And so most people just ignored this because everyone wanted the PPP. It was more valuable. Now you can potentially qualify for both. including retroactively for 2020 if you did qualify. So it's something to definitely revisit. And just at a real quick high level, essentially your business had to have a reduction in gross receipts for one calendar quarter in 2020 that was at least 50% less than it was in that same quarter in 2019. If you hit that, then you will likely qualify for this credit. And it's for 2020, it's up to, the value of it is up to $5,000 tax credit per employee that you pay wages to. It's more valuable even in 21. The rules are a little bit different for 20 versus 21. So and the rules are slightly different where you're looking at your revenue for like Q1 21, and if it's it's instead of 50% reduction, if there was at least a 20% reduction, I think, compared to that same quarter in 2019. So if your revenue has not bounced back yet, you can receive up to a $7,000 credit per quarter per employee. So 2020, it was up to $5,000 for the whole year per employee. 2021, it's up to $7,000 per employee per quarter for those first 2 quarters. One quick caveat is that you get PPP funding and you're using that PPP funding for your payroll. You will not be able to use that same exact payroll to calculate the amount of credits that you could qualify for. So there is some interplay to the two, but just really wanted to make people aware that this was out there in general. And if you have questions about it, definitely reach out or talk to your providers, because this is new to most people, and there could be a lot of tax savings out there for this. And then a couple of other really quick things. There's this emergency rental assistance program that is, I think, brand new with the Consolidated Appropriations Act, that they've put $25 billion to federally. They've allocated some specifically to like each state. So I think there's about $387 million that's available for Wisconsin. And it's essentially for landlords where their tenants meet certain qualifications and they either haven't been paying rent or struggle to currently. So essentially the 3 criteria that must be met for the tenant, and this is for residential, they must have qualified for unemployment or a severe reduction in household income due to COVID-19, potential risk of homelessness if they're gonna get kicked out, or I think if you're behind on your rent or your utility bills, that you hit that qualification. And then the household income has to be below 80% of the area median. So it can't just be like one person didn't have a job, but someone made a ton of money. So can't take advantage of it that way. But long story short, if renters like qualify for this is money that's going to get paid directly to the landlords from the government. So the tenants never see it, but it's a way for, if your tenants are behind on rent, utilities, or otherwise, and or are going to struggle to pay going forward, for landlords to get paid for a significant amount of that. So, and this is brand new, so there's going to be more to come. But if you do have questions, feel free to reach out. I don't even think technically money is available yet if you applied. I think the local jurisdictions are still figuring it out, but there will be more information, I would say, within a couple of weeks. And then there were Consolidated Appropriations Act, there were several like credits and otherwise extended. Energy efficiency credits were extended. We do a lot of work in this, and if you're not familiar with it, could be a lot of tax savings available. Just FYI, the 45L credit, this is for residential developers or renters. If you meet certain energy efficiency qualifications, you could receive up to a $2,000 credit per unit that you either sell or rent for the first time. So a lot of tax dollars out there. One last thing, I guess, to touch on, business meals are now 100% deductible for businesses for the next 2 years if you purchase it from a restaurant. So encouraging that type of behavior.
Oh, a lot to pack in there. there's always something new to look towards, right? Always a new bill, always new tax issues. We really appreciate that. Hey, I want to do one final quick question, and I want to do this kind of around the horn here. We'll start with Danielle. If we could just have one nugget that you want us to walk away from as we walk into 2021, and then we'll go to Josh and end with Chad. Danielle?
Yep. So I think one thing to walk away with is probably don't panic and sell a bunch of your stock because you're worried about the capital gains rate. Kind of let's see what the legislation is going to do. But that's kind of what I've heard a lot of people right now is just like this panic thinking that, hey, I'm going to get taxed at 39.6% on all my capital gains.
Great. Thank you. Josh?
Thank you. No, I would agree with the don't panic. There's a lot of time for us to learn a lot about what could change. Separate note, we haven't touched on it at all. I think opportunity zones are going to have a really big year. There's bipartisan support for it. And the program has just continued to pick up. Danielle and I do a lot of work in it, but if you're interested or potentially in that area, I think it's going to have a really big year. So.
I feel like we have another lunch and learn in the making here. Opportunity zones, 1031 exchanges. We could go on. All right, Chad, we'll end with you. What's the one thing we should walk away with today?
Chad, you're muted.
I would say the property owners should review their assessments, their notices this year for 2021. Pay close attention to comparing that to last year, and reach out to the assessor. If you don't feel it's fair, if you feel you're being overassessed, engage the assessor and make your arguments. And if you don't go anywhere, you could give me a call.
Great advice. Thank you guys for all of your time, not just insights and overview, but real practical things that we can walk away with, look more into, and actually do to help our businesses and our practices save money, make more money, and be more prepared. Chad, Josh, Danielle, thank you so much for your time. And I know that you'll continue to be a resource for us moving forward. I want to make a quick mention to others that if you go to our website, CARW.com, we have our slate of spring lunch and learns all ready to go. And then we're also doing some small group, socially distanced, CDC compliant tours coming up in the next couple of weeks, highlighting some of the wonderful work that's going on in our state and in our region. So with that, thank you guys so much and have a great day, everyone.
Thank you.
Thanks.
Thank you.